Hello, and welcome to this quarter's investment briefing from us here at Gemini Asset Management. Over the last quarter, there's been some interesting changes, so let's dive into it. In today's briefing, we'll touch upon equity market performance, bond market performance, and macroeconomic forces from around the world. Figure 1 on screen now shows the performance of various major equity markets over the last quarter, and you can see a striking divergence in their performance. Japanese equity performed the best, posting a quarterly return of 3.2% up, whilst European equities produced a negative return of -2%. The Japanese equities benefited from the Bank of Japan's contrarian policy, where it continued to hold interest rates in negative territory. A pretty marked difference to the policies from other major central banks around the world, as interest rates reached the highest levels we've seen in the UK for nearly 15 years. European equities fell, even in the wake of a pause on the rate hikes by the European Central Bank, and as inflation data came in below expectations, which shows that the potential for recessions to impact equity market performance are still very real too. The US equity market was relatively flat for the quarter, whilst the UK market was more volatile and posted better returns, ending the quarter 2% up, with much of the positive returns from the UK essentially being attributed to the large relative weighting that the energy sector makes up in the index, especially compared to other major equity markets around the world. As the oil price increased over the quarter, it had a positive effect on the UK market relative to others, and also helped offset some other areas of underperformance. Emerging markets had a turbulent time during the quarter, as investors bet on recession recovery in China throughout July, only to experience a notable pullback in sentiment following the further concerns surrounding the Chinese property sector. But equities are only one side of the story. Figure 2, on screen now, shows the performance of various bond markets over the last quarter. Government bonds performed the worst when compared to the other bond sub-asset classes, whereas investment-grade corporate bonds, essentially high-quality credit bonds, performed the best. As I'm sure you'll know, bonds have had a torrid time in the last year and a half. Really, ever since the interest rates were systematically increased at the end of 2021, in order to help combat levels of inflation that were ravaging the global economy. The positive performance of the corporate and high-yield bonds relative to the government bonds is tantamount to a risk-on trade in bond investing, as investors are pushing prices up at the higher-yielding, more risky assets. Even with this, bonds are yet to rebound robustly from their market lows. But it's still encouraging to see some positive performance generated as investors begin calling the top of the interest rate hiking cycle. As we've seen already this quarter though, that can be a pretty unpredictable game. Just in quarter 3 alone, we saw big changes as the Federal Reserve, the US central bank, paused its hiking cycle, as the consensus had expected, but then the Fed went on to essentially go out of their way to dampen down market expectations that any rate cuts would be coming anytime soon, and then even touched on the idea that they may not yet be done with the rate increases. As you can see in figure 2, this led to yet another sell-off in bonds towards the end of the quarter, as markets have been betting on essentially a more accommodative tone from Fed Chair Mr. Powell. The interest rate path is essentially going to be dictated by the strength of the economy, and as long as the economies remain in growth mode, regardless of how low the rate of growth may be, central bankers are still going to be worried about inflation. This may well lead to economic desynchronization around the world, but bring along with it some investment opportunities. Figure 3, on screen now, shows the Purchasing Managers Index, the PMIs, for the US, UK and the EU. The composite PMI for each region is essentially a temperature check on whether or not the economy is in an expansion phase or in a contraction phase, with a score above 50 pointing to expansion and a score below 50 pointing to contraction. As you can see, the UK and the EU are both in contractionary phases, whereas the US is still relatively neutral, albeit showing a downward trajectory. As long as the US economy is still plodding along and still growing, the Federal Reserve will likely keep rates high, which may continue to weigh on asset markets, bonds, and equities alike. If all of this sounds familiar, it's because it is. We've been talking about expectations for central bank policy being the main driving factor in the performance of most asset classes for a long time now. But it's worth remembering that slow-moving problems don't always have rapid solutions. With something as slow-moving as interest rate cycles dominating asset performance, the solution may still potentially be a little way off, and especially as central bankers are expected to keep the rates high for a while yet. Figure 4, on screen now, shows the US, UK and EU's expected pathways for inflation on the left-hand side of figure 4, and the expected pathways for interest rates on the right-hand side of figure 4. As you can see from the left-hand side of the chart, inflation is expected to come down pretty rapidly for the remainder of 2023, but interest rates shown on the right-hand side aren't expected to come down for roughly another 9 months. This highlights two things. Firstly, that slow-moving problems don't always have rapid solutions. This process has been going on for the best part of 2 years now, and as the charts show, we're not quite out of the woods just yet. But secondly, it shows that there may not always be an immediately snap back down in interest rates, even given the strong progress made on the inflationary front. Reflecting on this, the market sentiment still seems potentially to be a little bit mixed, depending on the asset class that you're looking at, as many investors are seemingly holding their breath for central banks to switch their stances. In the wake of all this, we'll continue to rely on our tried and tested methods of diverse portfolio construction to essentially try to help ride out the will they won't they interest rate volatility. But along with that, we'll keep in mind that markets are indeed forward-looking, both for equities and for bonds, so we're always assessing for new opportunities. And if there is some light starting to shine at the end of the tunnel, we're ready to take advantage of that. Of course, this doesn't guarantee positive performance right around the corner, but from an investment opportunity point of view, there certainly appears to be a little more positivity out there. That's all from us here today at Gemini, and if you have any questions at all, please feel free to reach out to your advisor. Thank you very much.